My name is Marcus Coleman. Again, I'm a Pine Bluff native. Went to Pine Bluff High, graduated from UAPB with my bachelor's in business with concentration in marketing. From there, I decided to pursue a MBA initially in management, and I ended up adding an additional emphasis in finance due to my love for the investment world, and began pursuing my doctorate in business with emphasis in reducing the investment portfolio risk. Today, our topic is straight talk on family finances. What I like to do is, in doing these type of seminars and workshops, and keep it somewhat informal. I found from experience that an informal dialogue, one-on-one, allows us to gain knowledge from each other, and we retain a lot of information. It also keeps us awake sometimes too. So we're going to look briefly at these different slides, which give us an overview of investment, family investing, and we're going to also have a little dialogue. If you have any questions, any concerns, you can feel free to interrupt me, stop me, or ask any questions, and at the latter part of the presentation, we'll have a session where you can ask some additional questions you may want more information on. Building a solid financial strategy is a lot like building a house in which we live in. I'm pretty sure no one has a house in here that doesn't have a foundation. Everyone home has a frame and also has a roof. And your investment house or your financial house is built the same way. You must have a foundation, a frame, and a roof to your investment house. The foundation of your investment house is the protection part. To protect your assets, you want to protect your income, you want to protect your life. There's some things that you can use to do that. It's having car insurance, you may have homeowners insurance, disability insurance, things of that nature. There's a few things that you can use to protect your assets, your income, and your life. The next piece of your investment house or your financial house is the frame. The frame represents the savings part. This is nothing more than having an emergency fund. One rule of thumb that I've heard is having a 6-month emergency fund of all your living expenses, just in case you may get laid off or you're unable to work for some reason, or some unexpected life event comes up. You want to be able to have some money in savings to sort of get you over that hump. The more money you have in savings, sometimes it's the better. I know 6 months is the rule of thumb, but it wouldn't hurt to have 8 to 12 months also in savings. And you can actually, some ways that you can save money. You may put it in a money market account. You may have some CDs, which a lot of us may be familiar with. Now may not be the best time to get them, but we still know what they are. Or just a regular savings account. The roof of your investment house is the growth or the investments themselves. This is where you get into the stocks, the bonds, the mutual funds. This part of your investment house is primarily for capital accumulation. You're just trying to put some money back, whether it be for retirement, whether it be for purchasing a new home, or you may just have some money you want to grow to have more money in the long term. Because as we know, gas prices aren't getting any lower. I think they just actually went up maybe 10 cents again here recently. And so you want to have some money put back or have your money growing. You don't want to have your money just sitting idle. You want to have it making you money over time. Some things you may invest in. You may invest in stocks and bonds. You may invest in real estate. Some people prefer investing in gold, investing in silver, because I guess gold, as we've seen, gold isn't going anywhere anytime soon. So whatever way that you feel, or whatever investment can get you the most accumulation or appreciation, that will fall under the roof portion of your investment house. So to summarize, your financial house is built a lot like your real house. You have a foundation, you have a frame, and you have a roof. Your foundation is the protection part. You want to protect your assets. You want to protect your assets, your income, and your life. You also want to have money in savings just in case something happens. And you also want to grow some money at the same time. Now, does anyone have any idea what happens if, instead of starting at the bottom and working your way to the top, what could possibly happen if you were to start at the top and work your way to the bottom? Do you see any risks or any red flags that could possibly occur? Hypothetically speaking, let's say that yeah, yeah, your financial house would crumble. Hypothetically speaking, let's say you take all your money, you place it into the roof. You don't build a solid foundation. You don't build a frame. Let's say that you get into a car accident and you have all your money in your investments. You have no car insurance. Where are you going to get the money from to repair your car and somebody else's car if it's your fault? Yeah, you're going to have to go into the roof, take money out of your investments. As a rule of thumb, you want to have the money that you place into the roof or into the investments, you want to leave it there for a minimum of 5 years. So if you take it out, and even after 5 years, if you're taking money out of your investments, you're stunning the growth of your investments. So it's slowing your growth down. And that's something that you don't want. You want to be able to put that money there and leave it there and let it continue to grow. That's the purpose of having the foundation at the bottom, which is the protection to cover your assets, your income, your life. Also having savings, because sometimes things come up, especially how many people have children and grandchildren. And as you may know, that when you deal with children or grandkids, there's always some unexpected event may come up. Yeah. Some trip at school, something that happens, some type of expense that you don't have to pay for that you had no way of planning for. So in having that, uncertainty in life, you want to make sure you have the foundation and the frame, some money put back to take care of those things, and not focus primarily on the roof. Which the roof, I like to call it the fun part, because everybody likes to make money. Nobody, on average, likes to think about paying money and for coverage or insurance and may not ever use, maybe not having to use it in any instance or never use it in any instance. But everybody likes to think about the investment part and making money and taking risks. It's sort of like gambling, something like that. But briefly, we're going to cover insurance planning, which falls under your foundation. How many people have heard of whole life and term insurance? Pretty much everybody. How many people have rented an apartment? Or rented a house or rented a condo? Do you all remember paying a deposit for that home? And you remember, yeah, it's supposed to get it back. And you remember paying monthly rent, signing a lease? And after you moved out of that apartment or out of that house, by show of hands, how many people were refunded all those monthly rent payments? Nobody? Some people got the deposit back. I know some places don't even give you the deposit back if they have to go in and shampoo the floors, or you don't even get all that back. That's essentially how term insurance works. It's for a period of time. Just like you stayed in an apartment while you were saving up to buy a house, that's how term insurance works. For instance, if you were to go out and get a home, and that home costs you $250,000. Worst case scenario, something can happen to you where you no longer have your income, but you're still going to have that home payment. And if something were to pass, you don't want to leave that $250,000 to your survivors. So what you would do is get a term insurance policy for however long you have left on that mortgage. And if something were to happen to you within that 10 years, then you will be able to pay it off. Or your survivors will be able to pay it off. That's what it's for. In contrast, whole life is like buying a home. We buy our homes and we begin to fix up on them. Anybody made any repairs to their homes here recently? It was sort of costly. The good thing about that cost, it increases the equity in your home. So you may have bought a home for $100,000, and within a year or so, it may be worth $250,000. That's just like a whole life policy. You're paying those premiums over a period of time, and even though you're paying those premiums, you're building a cash value. So that's like equity. And just like in our homes, if we need a credit line, we can borrow money from that equity in our homes for unexpected events. That's the same thing you can do with your whole life policy. Group coverage. Is everyone enrolled in their employer-sponsored insurance plans? Does anyone recall how they calculate the amount of money that they pay for those plans? Essentially, I'm pretty sure in working on your jobs, over the past few years, you've seen people retire, you've seen people get laid off, you've seen people quit or people get fired. Well, the benefit of having employer insurance, well, the way that it works is they calculate, the employer pays a certain amount based on an average age or gender, things like that. That's why you have group coverage. The group coverage is beneficial. The deterrent to group coverage is that once you leave, you're no longer covered by that insurance policy because you're no longer working there. So it also is a term insurance policy. In contrast, your individual coverage, you pay the premiums. It's based solely on you as an individual, and you have, as long as you pay the premiums, you own that policy. What I found some people do is that they rely solely on their group coverage because they have insurance at work. They feel that they don't need any other coverage outside of work, or they may get it when they retire. But the problem is, hypothetically speaking, let's say you work for 30, 40 years, and you say you're going to get insurance once your group coverage runs out. But when you retire, you're 65, 67 years old. And the way the insurance premiums are calculated, they calculate it based off your gender, and they calculate it based off of your age. So if you're 65, 67 years old versus being 30, 35, it's going to cost you a lot more money a month to get that coverage. Saving for education. How many people have children or grandchildren or godsons or daughters that they're looking at sending to college or graduate school? Have you all begun to look at different options, or what type of things have you seen or read about?
Savings bonds.
Savings bonds. Okay, that's one that I know was very prevalent a while back, with there being so many different investments now. Some people still use savings bonds. Some people are drifting toward a few other things. We want to look briefly at some of those other options. How many people are familiar with the 529 plan or have heard of the 529? That's also one of the more prevalent uses for or planning tools for education. We have Coverdell educational savings accounts and uniform transfers and gifts to minors. A 529 plan, the key advantage to a 529 plan is that it's an account that you can set up for a child or even an adult that allows you to put money into an account for educational purposes and not paying taxes. And those are two words I think we all like to hear: tax-free. So it allows you to not have to pay taxes on that money, as long as that you keep that money in an account and use it for educational purposes. If you do take it out and use it for something other than educational purposes, then it becomes taxable. That's the way it works. Another key advantage of the 529 plan is that it may be deducted on your taxes in some states. It gives you a tax deduction. It also allows you to, say for instance, you have a child or a grandchild, that child gets scholarships to college, and they have a brother or sister who didn't get awarded as much money as they did. Well, you can also transfer that 529 plan to that brother and sister. Even though initially it was set up for that initial child, that child may not need the funds, you can transfer that account to another relative. Another benefit of it is, say for instance, you only have one grandchild. So what do you do with the money now? They got all these scholarships, they've been awarded all this money. That child may decide to go to graduate school. You can also use that 529 plan to pay for graduate school. And the funds can be held in an account up to age 30. So it doesn't have to be liquidated when the child turns 18 and goes to college. So it gives you a little, planning time for them to decide if they want to continue their education or what they would like to do.
Can that only be used for tuition, or can it be used for books and housing and stuff?
It can be used for books. There's a list depending on what state it's set up in, because each state has a different 529 plan of qualified educational expenses, but it does not have to solely be used for tuition.
Is there a yearly limit as to contribution to that plan?
The limit, I don't recall there being, in the tax codes and different things change, but I don't recall there being any limit on the amount you can place into the house.
What do you talk to get that?
Ma'am?
Who do you talk to get that?
Who do you talk to? That's a very good question. Typically your banks or your brokerage firms have 529 plans. You may be able to type, I know the state administers one, and you may be able to type in Arkansas 529 and should pull up a link for you to access that. But if you have a financial advisor, if you have someone at Merrill Lynch or Edward Jones, they will also have access to different 529 plans as well. And even some of your online brokers should have access to 529 plans, your Scott Trades, your TD Ameritrades. The only difference in using someone, having a financial advisor and using an online brokerage firm is that you may not have that personal relationship. And with someone in person, they can sit down and go through, your risk, exactly what you want to do, and build a customized plan for you. Whereas you are more independent if you use something online.
And what was the website again?
I'm not sure the exact website, but I'm pretty sure if you were to go to Google and type in Arkansas 529,
Okay.
it should be able to pull up the link and you'd be able to see the states. And each state's 529 plan varies. And you're not limited to only getting Arkansas. Say, for instance, if Virginia is one that I've used in the past, if they have a more advantageous setup or system, then you're able to use theirs. The Coverdale Educational Savings Account is much like the 529. It has the same general purpose, except you're not able to deduct the different contributions. It's typically it can be used for ages, or from grades K through 12, for their educational expenses as well. And there is an age limit that you have to have the money withdrawn out, and you're also not able to transfer it to another child. The UTMAs and UGMAs. What these are investment accounts that are set up in the name of the child, but it's overseen by a parent or guardian or a relative or friend of the child until that child becomes of a certain age. I believe the UTMAs, the age is 18, whereas the UGMAs is maybe 21, 22. Now, that would be at your discretion. I'm pretty sure a lot of us would want to hand over $50,000, $100,000 to an 18-year-old.
Of course not.
And so, exactly. And the reason being, unlike the 529 plan where it's in the name of the parent or whomever sets it up, they have complete control. Once that child turns 18 or 21 or 22, that account is theirs. It's theirs to begin with. It's actually filed under their Social Security number. And the taxes the child pays taxes at the parent's tax rate until they turn 18. Is how it works. And once they get to that age of majority, 18 to 21, they then have full access to that account. They can spend their money however they would like to. That's how it's set up. It can be used for education. It can be used for essentially anything. But it's also another supplement to saving for education, for your kids. Okay, retirement plan. Anyone in here looking at retirement anytime soon? Got a couple people. Want early retirement? What type of things have you all begun to look at? Have you all decided how much money you need for retirement? What are some of the things that you all would like to do during retirement? Relax. Traveling. Keeping grandkids, anybody? So we're traveling to stay away from the
Right.
Okay. Well, the type of lifestyle that you lead, during retirement, affects the type of when you should retire and the amount of money you need to retire. It also affects the type of plan that you need to do for retirement. Because if you're going to be doing a lot of traveling, more than likely you're going to have more expenses than someone who's at home doing a lot of gardening, except for buying the soil and the mulch, stuff like that. So it varies greatly in the amount of expenses that you have versus, based on what it is that you're doing. Is everyone familiar with the IRA? It's an acronym for individual retirement account. You have two categories, you have a Roth, you have traditional IRAs. Does anyone participate in an IRA through work or outside of work? Well, what did you have yours set up with, if you don't mind me asking? The bank? E-Trade. Those are good places to have your IRAs. And a Roth IRA, the key advantage to a Roth IRA is that the money you place into it, after a certain period of time, when you take it out, you don't pay any taxes on it. The maximum that you can place into a Roth IRA is $5,000 per year, up to age 50. Once you turn 50, you're able to invest $6,000 a year. And they make that allowance for you because they know you're getting closer to a retirement, and they're allowing you to put an extra $1,000 a year to sort of give you, more accumulation the closer you get to a retirement. Because depending on where you work, some people may retire at 55 versus 65, 67. The traditional IRA works similar to the Roth, except for the money that you place into it is tax deferred. The money some people will have traditional IRAs attached to their 401ks. That's money that goes in and has not been taxed. And as we all know, there's essentially no way of getting around the IRS. So if you were to, hypothetically speaking, place money into a traditional IRA and didn't pay taxes on it, when you take the money out, they tax you. It's how it works. I've even been asked, well, what if you take money and roll it over, not into a traditional IRA, from a 401k into a Roth? As soon as you move that money from a 401k, which has not been taxed, into a Roth, they consider it as being a withdrawal.
Right.
So it's not a rollover, they consider it as being a distribution. So all that money, which that's very dangerous, because instead of a small portion versus, for instance, if you were to take just a monthly amount out, traditional, you pay taxes on that, versus rolling that money into a Roth, you'll be paying on that entire lump sum at one time. So you can be hit with a heavy tax penalty.
That's right.
And you also have early withdrawal penalties if you were to take money out your retirement accounts. Less than 59 and a half, you would have that extra 20% penalty. You also have income taxes on it. The main thing behind your retirement accounts, your 401ks, your IRAs, is that you want to put money back, not pay taxes right now, let that money grow, because you're in a higher income tax bracket than what you would be in when you retire. You may be in the 33, 34, 35% income tax bracket now because you have income coming in. But once you retire, you may drop down to 10. So 10% is a lot less than 33%.
That's right.
So that's the purpose of using using these type of retirement accounts.
Now, on retirement accounts, though, you can't put the whole $6,000 into a Roth if you're going to put some of it into the traditional. That's total, right?
Yes.
You have to split them.
Yeah, if you have a Roth and a traditional, which there are limits. There are limits on like who can get a Roth. If you make over $120,000, you can't get a Roth IRA. But you would have to get a traditional. But that's a good point. There's only a certain amount of money that you can put in these accounts to keep it tax deferred per year. And does anyone in here have TIAA? CREF? A couple people. TIAA stands for Teachers Insurance Annuity Association. Essentially, why is TIAA CREF? Because you had two companies combined. TIAA is the oldest insurance company, to my knowledge, in the world. I know in the U.S., with Mass Mutual being the second oldest. CREF is the investment side. The TIAA side is an annuity. What an annuity does is, for instance, you're working, they're taking money out of your check, so you're making payments into that annuity. Every pay period, every 15th and 30th. And when you retire, they're not going to send you a lump sum of all that money. I've had clients that were somewhat, or have heard of people being somewhat, amazed or shocked when they got ready to retire. They couldn't draw all their money out the TIAA side. That's because with the way an annuity works, they're paying you interest on that money. Every time you get paid, you put money into that account, they're paying you interest on that money. What they're doing with your money, they're taking your money and they're investing it into different things themselves. If the market is up, they're paying you 3%. If it's down, they're paying you 3%. So if you get that 3% for 10 years and they haven't made their money back and they just give you a lump sum money, they haven't got any type of return on their investment. It's what it is. So what they typically do is, for 10 years, they pay you, for instance, if you have $100,000, they split that up over a 10-year period. It's how you get that on the TIAA side. That's how an annuity works. You have the accumulation phase, where you're just accumulating funds into that account, and then you have the withdrawal or the distribution phase. During the accumulation phase, you're just building up money, you're getting interest on it. During the withdrawal phase, you get a fixed amount over a fixed period of time. It's how it works. The CREF side is the investment side. That's the side that goes up and down. You can invest in the stock market and different things of that nature. When you retire on the CREF side, you can take out a lump sum of money on the CREF side, but you wouldn't be able to on the TIAA side. Okay, the investments. What are stocks and how do they work? Stocks represent a percentage ownership in a given company. Stocks are issued by publicly traded companies. We're all familiar with Walmart, McDonald's, Target, Dollar Tree, different places that we shop. Those are publicly traded companies, which simply means that they have shares outstanding, meaning that you can go to a broker and buy their shares and become a percentage owner in that company. The shares can be purchased and redeemed any business day, and some of these companies even pay dividends. The purpose behind stocks is pretty simple. If you start a business, you may have some money to start off with, but eventually you come to a period where you're still trying to grow your business, you need more money. So the companies, they borrow money from outside investors. They either issue stocks or they issue bonds. Stocks just exchange a percentage ownership. They essentially say, my company is worth X number of dollars. And if I split it up into X number of shares, one share is worth this. I need to raise this amount of money to continue to grow my business. So I'm going to sell you a share of my company at this price. So they take their money from you and they reinvest it back into their company. The benefit for you is when they take your money and reinvest it back into that company and you hold that stock and that company continues to grow, it grows more, and instead of being worth $1 million, it's now worth $2 million. The percentage that you own in that company has just gone up by 100%. So that's the benefit, that's the purpose of investing in stocks in a nutshell, is that you want to invest in companies that are going to continue to grow. So that the amount of money or percentage ownership you have, the value of it continues to go up. Bonds are similar to stocks. They're issued for the same reason. The companies need money to continue growing, except for in this case, they don't want to give you ownership, part ownership of the company. They would much rather pay you interest while they're borrowing your money. And at the end, after they get through needing your money, or after they get what they need for their company, they want to pay you off. So you receive interest, sort of like credit cards. How many of us have credit cards or have had credit cards? You know, we could easily wait until 2 weeks when we get paid to go buy whatever it is we want, but we decide that instead of waiting for 2 weeks, I want this outfit. I want to go out to eat at this place. I want to do this. I want to do that. So what we do, we pay interest on those credit cards for that 2-week time period. And that's essentially what the company does. They need the money to grow their company now instead of waiting until they make enough money to grow, to continue growing their company. They say, I'm going to pay for time. It's time value. I'm going to pay for the time I need. Instead of waiting, I'm going to pay you interest to borrow your money instead of me waiting until I get the money that I need. That's how bonds work. How many people have heard of or are familiar with mutual funds? Mutual funds are just a more cost-effective way of investing. The first mutual fund started back in 1924. I believe at that time, GE stock price was about $221. The only problem with that is that the average yearly income in 1924 was $2,000. So if you're only making $2,200 a year, you really couldn't afford to buy a stock that was a couple $100. So what the mutual funds the idea behind mutual funds, because we've all heard about diversification. You don't want to have all your eggs in one basket. Just buy all of one thing because it increases your risk. To allow people to have a lot of different investments, not risk all their money on one thing, they pool the investments together. So you have not only Walmart, you might have Walmart, you may have McDonald's, you may have Dollar Tree, you may have Exxon, a lot of different companies in the pool. So you buy that fund, and that fund owns all those different types of investments. And typically a mutual fund is a lot less expensive than owning a single share of stock. Because Walmart stock maybe it's normally around the 50s, between $50 and $60 a share. It fluctuates within that range the majority of the time, versus buying a mutual fund for $12. So instead of paying $50 for one share of Walmart, you may buy one share of a mutual fund and own 100 different stocks. So you don't have all your money in Walmart. You have your money spread around 100 different companies. And at this time, I'd like to open up the floor. If there are any questions or any concerns, because I know a lot of times you go to workshops and seminars with a particular question, a thought in mind, which drew you to the workshop, but due to time constraints and a lot of paperwork and presentation, you can actually get the benefit of coming, or get the question asked that led you to come. So this time, I'd like to open the floor up for any questions or any concerns.
If you have any investment in certain stocks and the market is falling, would you recommend selling or just riding it out? What would you do? If let's say that you have a couple hundred shares, 1,000 shares in Walmart, a Pilgrim Pride, or something like that, what would you do?
That's a great question, and it would depend on the stock. It depends on the investment that you own. For instance, dealing with Enron. If you own Enron stock, I'm pretty sure there were people who back in a few years ago they were saying keep buying as it was falling, and as we see, that wasn't a good idea. Versus had you have owned another stock, say for instance Dollar Tree, while it may have been down, Dollar Tree, I actually put a client in Dollar Tree a while back. I think we bought it maybe at $70-some a share. Last I checked, it was at like 83, something like that. And she's put a few $1,000s in it. So just because the stock is falling does not necessarily mean that you can pull out immediately, because the stock market is more emotional than it is logical. Because people make investment decisions. A lot of times it has nothing to do with the underlying company. For instance, have you seen the fluctuation in oil and gas prices? A lot of that's caused by what's believed, like things are going over in Syria, going on in Syria. There's a belief we may have a shortage in oil. I think gas may have just went up by 10 more cents as of today, something like that. So the changes in value is based on, a lot of times, things are not considered to be fundamental. So that's where your advisor comes into play. I recommend, screening your advisors. I know you might have a lot of people coming at you, saying they want to manage your money. I even wrote an article just outlining a list of questions to ask. Some of those are, how long have you been doing this? Where is your money invested? Why should I invest with you? What incentives do you have to make me money? Because what a lot of people don't know, when you deal with brokerage firms, the stockbrokers, the financial advisors are paid on the amount of money that they bring in, that they manage. They're not paid on the performance of that money. So if there is no incentive for them to make you money, and you don't know their background, it may be a risky decision to let them manage your money. But as far as should you pull out, should you sell, should you keep buying, that's something that it depends on the company, and that's something that your advisor would have to.
What if you invested through your bank?
Investing through your bank. Typically, your bank should have an advisor, whomever sold you that investment. In every company, there's no perfect company. Even the best companies, every company has some underperformers and some overperformers. So you're going to have some people who do exactly what the company tells you. Another thing that you generally don't know, each company or the mutual fund companies, they have relationships with the brokerage firms. So at any given time, a brokerage firm could be told to sell a certain investment. not because it's the best, but that's the relationship that they have with that other company. And those are some things that you wouldn't know unless you worked in the brokerage industry or you know somebody in the brokerage industry. So I would just suggest asking a lot of questions, seeing what their educational background is, also seeing what type of continuing education they're doing. Because what I've seen in the past is that a lot of people get into the industry, they do what they need to do to get licensed, and in their mind it's more set on making money for themselves than it is for taking care of their clients or continuing their education to become, because the world is constantly changing. The investment selection that you would have made last year, would not work. Some of them would not work this year because it's constantly changing. If you don't have an advisor that's constantly updating his or her knowledge, they're putting you and your investments at risk.
Yeah, could you explain the different types of stock markets like NASDAQ and what have you, and then how to read the stock report?
How to read the stock reports and the stock markets?
Right.
The the big ones that we have here, and the main ones that we have here in the U.S. is the Dow Jones, the S&P 500, and the NASDAQ. The Dow Jones, I know we hear a lot about that on the news. You would think it's about 30,000, a myriad different companies. In actuality, the Dow Jones is 30 of the biggest companies in the U.S. There's only 30 companies, but they're the biggest companies. They're your Walmarts, your McDonald's, your big companies, your Exxon Mobils. Those are the biggest companies here in the U.S. The reason that the Dow Jones is important, and a lot of people follow the Dow Jones, is because they figure that if you're bigger companies, wherever direction that they're going in, that's a predicator for the rest of the market. Because they're so big, they're valued so highly in the overall market that their movement can fluctuate the entire market because they're so big. The S&P 500 is what's called the benchmark for the entire market. A lot of times you may hear people say the market did this or they performed this amount over the market. But when they refer to the market, they're talking about the S&P 500. It's just the 500 biggest companies here in the U.S. The NASDAQ is typically your index that tracks the majority of your technology stocks, your Apples, your Googles. So it's an index that is comprised, I believe, of 5,000, and it has the majority of technology stocks, and it's the breakdown. It's the breakdown.
So the S&P 500 also includes the 30 from the Dow Jones?
The S&P 500, yes, does.
So they're ranked too.
I had a question about life insurance. My husband and I are in our mid-50s, and I have life insurance through my workplace. He does not. Is it as important to get life insurance coverage as you get older, as more so or less so than when you're younger? Or?
That's a good question. It would depend on, well, first of all, the older you get, the more expensive it would be.
Right.
And it also depends on, I know a lot of times you have people trying to sell you insurance. Essentially, it's a certain amount of insurance coverage that you do need. It's based on your income, how much debt you have, and other events like you were just having children. Essentially, what you want to do is you want to look at your income versus your expenses, your debt, or how much overhead you have. And the amount of insurance that you want to get is equal to the amount, if you were to decease, how much would it take to pay off all your debt and take care of all your expenses. And also, if you say, for instance, if you're in a relationship, you're married, how much income would you want to leave that person, your survivors, in the first 2 years or first 3 years. For instance, if you have a mortgage, you have car notes, multiple cars, it's a lot harder if you go from paying those bills jointly and having one person pay those bills. You have one income coming in. If you have $100,000 income and it suddenly shrinks to 40, you still have the same expenses. You're gonna need some money from somewhere to cover those expenses. So that's the purpose of life insurance. So you have to add up your expenses, all of your debt, everything that you owe versus your income. And if one of you were to be deceased, essentially the percentage or the contribution that each one of you is offering toward that debt, toward those expenses, that's the amount of coverage you want to have on that person.
So there's some formula for that?
Yes. Yes, even if you were to buy a house, your debt just went up by however much that house is. So you may want to get a term policy. Essentially, as you make changes to your life, you get new cars, you get new houses, you're supposed to update your insurance coverage. Because should something happen to you and you have a wife or a husband that's left with a $50,000 car note, you could have easily paid, X number of dollars for term life insurance for however long your car note is, for 3, 4, 5 years. And if something happened to you within that window, then that life insurance policy will allow them to pay off their car note. So they wouldn't have to worry about where they're going to get the money to cover their car note.
So the older you get, is it more advantageous to go with term than whole life, or opposite?
Whole life is always, well, I'm not gonna say always, whole life is more advantageous than term in the beginning. At an old age, it depends on your situation, it wouldn't be, because whole life is more expensive than term, because it has different benefits. You have the cash value build up, and depending on how old you are, it may take too long to build up that cash value for you to be able to utilize it. So depending on your situation, term may be a better fit for you. It depends on your income level, your ability to pay the premiums, the amount of debt that you have, a lot of different things. It varies on a case-by-case basis, is what it is. But if you are able to get whole life while you're younger, or be able to afford it, then whole life is a very good option. Term is typically for covering short-term needs, like mortgages, car notes, a child's education. If you're paying for your kid's education, you want to be able to continue to pay for it. You might take out a policy on yourself. So if something happens to you while that child is in school, that life insurance payout can be used to continue to pay for their college. So it wouldn't grossly alter, their lifestyle. Is essentially what it turns.
TMI, is that to protect you or the company? Because they force you to pay it, put down 20%. Does it protect you? Do you get the house, because you're paying basic mortgage insurance.
That's a very good question. I haven't looked in depthly into the mortgage insurance realm. That's something that I would have to maybe check more into, more in depth, to see exactly how it's set up. I would think that it varies on a case by case basis, and depending on the insurer and who you get the mortgage from, because the mortgage originator has essentially the most discretion in structuring the way the contract is set up.
One comment, it was similar to the gentleman asked you about the trading, as far as if you notice when stocks may be falling. I think there's a method for when you can, is it options or something, or puts or something, whereas you can buy a stock at a certain price and you can sell it when it, I guess you'll be able to sell it when you buy it at a price, you'll be able to sell it at that particular price, regardless of what the value of the stock is at the time. I'm not sure what the term is, but I know it's something.
You're speaking about options.
Options, okay.
Options are great for reducing risk. They're actually a risk reduction tool.
Yeah.
Is what they are. For instance, I had a client back when, how many of you remember when Southwest had those, had the issues with their planes? Planes were messed up, had maybe 3 or 4 had cracks in them. Even though it was maybe a couple of them, the stock began to plummet. I had a client that was in Southwest stock. At the time, Southwest was doing okay. Once that news, broke out, it sent the stock down. What I recommend doing, one thing that I could have done in that instance is I could have bought puts, what he was speaking of, that the lesser that the stock dropped, the value that I locked in on that put, I could sell it at that put price. So if I bought it for $50, and I also bought an option, a put option at $50, when that stock dropped down to 30, I could sell it at 50. That's what he's speaking of. And that's something else you would also want to discuss with your advisor, because all options, it's a risk reduction tool, but there are some risk and options if you try to utilize them and you don't know exactly how to utilize them. There are, a lot of very different combinations to use options, a lot of instances that you can use options in. But I would recommend asking your advisor about options and also what risk reduction tools do they have in place. If they don't have any tools in place to reduce the risk of your investment portfolio, then you may want to look for another advisor.
What do you think about a road investor? Let's go out there and buy and just
as far as just, someone that's not a licensed advisor.
Someone like me to go to the bank and buy me some Pilgrim Pride, when you go up $8 a share, I'll sell it to make. It's money like that.
My,
Is that a big risk?
my advice, before I officially got into the investment field, I actually began investing on my own. I did a lot of research, reading books, things like that. One of my main successes was, it was a company I had researched. It had not been profitable 10 years in a row. It never paid a dividend. And before I sold out of that company, I was blessed to get a return of 74.62%. And that was before I even entered into the investment world. So you can actually learn and do things on your own, but it takes a lot of time. Essentially, for every investment that you own, you're supposed to invest at least an hour per week on researching that particular investment. So if you have 25 stocks, that's 25 hours a week. That's a part-time job. So that's the purpose of hiring an advisor to do that for you, because that's all that they're supposed to be doing. The issue becomes, or the issue arises when you hire that advisor to do that, and they're not researching. All they're doing is selling you a stock and making you they're making a commission off selling you that stock, and then the stock price goes down, and they just tell you to buy more, and it keeps going down, and you keep buying more, and you back. That's where the problem comes in. Okay. Were there any more questions? Concerns? This time I'll turn it back over to John.
What do you think about stem cell stocks?
Stem cells.
And
Those are some, I looked at a couple of those stocks.
that's the future, I think.
It could very well be. The thing about it, something that I've learned in investing, you may have, the right answer, the right company, but it can be the wrong time.
Right.
Because with stocks,
They're going up and down. When you're a dollar, now you go a dollar, they went up to $9. So you buy 1,000 shares and stuff, you look good.
yeah. The thing is that investments in stocks are affected by a lot of things that we have no control over. Dealing with the stem cell research, I know one of our presidents cut out research dealing with stem cells. So if the companies could not research and get funding to continue to do stem cell research, they couldn't make money. And they weren't progressing as a company. And here recently, I believe the research may have been opened back up, so the stock price may be going up.
Yes.
But you have to be able, it's a lot of different things you have to look at. Other than the company may look good financially, they may not have any debt, they may have a lot of income coming in. But if regulators sort of stop them or put a stranglehold on them from doing their operational activities, it affects their profits, and then it affects the stock price. Because essentially, the reason you're buying a stock is because you think that company is going to be profitable. If anything happens where it looks like that company is not going to be profitable, the stock price is going to go down. So dealing with the stem cell research, I would just do as much research on just stem. I would even start off by looking at what exactly is stem cell research, what processes and procedures, how do they do stem cell research? Because every bit of information that you get can help you in making this investment decision. Like you may know that it's better for them to use one raw material than another raw material. So when you, just from doing general, research, so when you read about a company using a material that doesn't work as well as another one, you already know in your mind that they're taking a shortcut. Right. Whereas somebody else who hasn't done the research, they're thinking, okay, they don't see it because they don't know what raw materials go into doing the research.
There are some stocks that you can only buy through a broker. There are other stocks that you can buy directly from the company. Is that correct?
You mean as far as stock options?
Yes. Would you speak about that?
Stock options, say for instance, companies like Walmart, Tyson, they have what are called stock options. It's just a way for you to accumulate stock in your company that you work for, but you get it overall at a cheaper price.
No, that's not what I'm talking about. There are companies where you can buy the stocks directly from the company. You do not have to go through a broker.
You typically, no, you have, initially you can. You're speaking about initial public offerings, when a company is private and then it goes public. Is that what you're speaking of? Because
I don't know. I mean, that's what I'm asking you. I thought there were companies that you could buy you could buy the stocks directly from them and you didn't have to go through a broker.
That, the only instance I can think of that is in stock options when you work for that company. Otherwise, you have to go through a broker. A broker is nothing more than a middleman. Whether it's real estate, whether it's insurance, whether it's investments, the term broker is nothing more than a middleman, is what it is. So a broker is placed in that position to facilitate taking something from one person and giving it to somebody. They're the middle person. The stock option is the only other way that you would get that stock directly from that company, because you work there.
And you can be your own broker
Yeah, you can use an
online.
yeah, you can use online brokerage firms, which are okay to do as long as you have the time and inclination, to do research, and in which they provide you with different research tools depending on which one you use. You can do a lot of things on your own. You just want to make sure that you can stay on top of where you need to, so that you won't wake up one morning and you're running with all your money.
What is good retirement advice for someone under 30?
Under 30, are you still paying back college student loans? I would pay on my student loans. I would contribute up to the match at my employer. Once my student loans are paid off, I'll start looking at if you had extra money, instead of putting it into your employer-sponsored retirement account. For instance, if they're matching 3%, I wouldn't put in 6%. I'll put in 3%. An additional 3%, I would put into a Roth IRA. That's one thing that I would do.
So how would you put that in? What would be the advantage of putting that in a Roth versus a traditional?
A Roth versus a traditional. The advantage of putting it into
that extra 3%.
For the extra 3%, the advantages of putting it into a Roth versus a traditional is that when you place money into a Roth, eventually it converts all the money into tax-free money. The money you place in there is tax-free to begin with, but you're putting your money into that Roth IRA to grow it over time. Now, normally you would have to pay taxes on the money that you grow, but because it's in that Roth IRA, it can grow, and the growth it becomes tax-free. So that's the key advantage of putting it into a Roth. Okay, if there weren't any other questions, I'll give it back over to Don. Thank you.